Hello everybody, welcome to Monday Morning Must-Knows. My name is Merlin Rothfield, and here are 3 important things to pay attention to for the upcoming trading week. Now you may be asking yourselves, why hasn't he talked about Russia and the Ukraine? Well, that's one of these things that's just going to be kind of looming over the markets for a long time until it's resolved. So I didn't really want to pinpoint a specific day to go over that data. Be careful, one day it's going to be war, next day it's going to be peace, who knows? I think we're all hoping for a peaceful resolution to it, but it could put more volatility into our marketplace, which we've seen over the past couple weeks. So let's start things off with something that I can tell you is definitively going to happen, and that is earnings. Yes, we're near the tail end, but we do have quite a few companies reporting earnings. 894 companies reporting this week. We start things off on Monday with Lucid Motors. That's right, the EV, electric vehicle darling that everyone's raving about. Price chart hasn't looked that great recently, but they report earnings on Monday. Tuesday brings you Home Depot, Macy's, Palo Alto Networks, Medtronic, and Transocean Energy. Wednesday, you've got Chesapeake Energy, Lowe's, Network Appliances, TJ Maxx, eBay, and Hertz. Thursday, you've got Alibaba, who will finally, hopefully, finish reporting because it's been weeks since we've talked about them reporting, and they still haven't done it. We've got Square, Etsy, and Dell. And then Friday, a couple big names. We've got Cronus, which is in the cannabis industry, Budweiser, of course, Anheuser-Busch, Berkshire Hathaway, and Foot Locker. Convenient that we have a cannabis company and an alcohol company reporting on the same day. Now, let's talk about something that we don't normally talk about on here, which is real estate. As you know, real estate is about 14 to 15% of GDP. So if all of a sudden we see real estate markets just surge, that could be great for our economy and GDP numbers continue to rise, as they are very high right now, running about 6.9% GDP, which is very lofty given historical norms. But what happens if real estate all of a sudden starts to tank and starts to drop significantly? Because many people are saying we are in a housing bubble. Of course, they're also saying we're in an equity bubble, a housing bubble, a bond market bubble, a crypto bubble. We're in a bubble on top of a bubble on top of a bubble. Well, who knows if anybody on that plane is right, but at some point, bubbles pop. Now, I'm going to show you some charts here on real estate, at least one specific, and this is IYR. This is a real estate ETF put out by iShares, and if we take a look at the chart, you can see that it has been on a beautiful uptrend. Like if you were to open up Uptrend magazine, this would be the centerfold. I mean, it's just beautiful. Higher highs, higher lows. As of this picture right here, it's on an uptrend. Nobody can argue that, no matter what indicators you're using or support, resistance, supply, demand, trend tools, whatever, it's on an uptrend, clear. Now, what's going to make that uptrend change is if we start to see new lows being put in. So focused on the right-hand side of the chart there, right where price starts to have its sharp decline. It's still in an uptrend, just had a pullback. But wait, all of a sudden we see this happen. Boom. Not only did it sell off, but it broke lows. Now we can put a line across the bottom there, and you can see a different picture. That uptrend is no longer intact. It's starting to show significant weakness. And where the weakness really shows up is in this little red square here, where in the most recent month, it tried to rally back up because it wasn't an uptrend. Let's have that rally, and it didn't make it. Came right back down to that horizontal red line you see. This is a fairly negative situation because what it's showing is the price of the properties in this ETF. And again, this ETF is a representation of companies in the real estate space. But if those companies are falling out of favor, as the price is reflecting right here, that means that real estate as a sector might see more downside movement if certain conditions are met. This is definitely not financial advice. We're not saying short the market. It's just saying be careful here because as we can see right now, price has dropped and is sitting right on that red line. Now, why might that be occurring? Well, if we take a look at the mortgage rates, here we have the 30-year fixed rate mortgage, the 15-year fixed rate, and the 5-year adjustable rate mortgage. You can see going back to the left-hand side of the chart here, we go to March of 2021, and prices were still going down. We were getting cheaper and cheaper mortgages. That top line, which represents the 30-year fixed rate mortgage in purple there, drifting down below 3%. Imagine getting a 30-year fixed rate mortgage for under 3%. It was possible, and people were locking those in. But wait, something happened to mid to late 2021 that all of a sudden caused those rates to rise significantly. We've gone from under 3% on the 30-year to over 3.92 as of the recording of this. Now, why is this so important? Because as the price of mortgages rise, the ability for people to make mortgage payments declines, meaning it could potentially price people out of the market. Let's say, for example, you found yourself your dream home in Newport Beach, California, $1.5 million for a one-bedroom condo in Southern California. Now, you found this place, you love it. You got to come up with 20% down, right? All right, $300,000 cash, there's my down payment. which means I now need to go get a loan for $1.2 million. Okay, let's say I qualify. I've got some money in the bank, this data here, everything looks good, and I qualify for a $1.2 million loan at 2.8%. Well, let's say it took a while, and all of a sudden now I finally finish, and I get locked in at 3.9. That 1 full percentage point could increase my monthly payments so much that I now put myself in a precarious position as a property purchaser, and I may actually back out of the deal because I can no longer make those payments. Now, if trends are your friend until the bend at the end, and looking at this chart, we're seeing prices go up higher and higher and higher. Does that mean we're going to see the 16% 30-year fixed rate mortgages like we did in the 1980s? Probably not. But these are historically low levels. What if we got to 5%, 6%, 7%? If we did, then that chart of IYR that we saw is going to break that little red line and most likely seek out the next area of demand, which could be significantly lower than where we are at right now. Now, for the grand scheme of things, yes, this is Monday Morning Must-Knows. And is that an actionable item for this week? Well, probably not. But it's something to keep an eye on because if that level breaks, more people will be following, maybe even shorting IYR. All right, I went way too long on that one. Let's talk about Core PCE Price Index, which is the best measure of inflation that the Fed looks at. We talked about CPI and PPI on this program, but the Fed said, nope, we don't want to hear that. We're focusing on Core PCE Price Index. And if you look at this chart, you can see historically, going all the way back into 2014, we have not really broken above this horizontal red line until mid-2021. And all of a sudden, we're seeing sustained levels above that red line, which means inflation is getting higher and higher. And I know that you feel it, whether it's at the grocery store or at the gas station, prices are higher. Now, 0.5 was the most recent reading. Why is it so important? Because right now we're in a situation where the Fed has said we are going to raise rates soon. Well, soon, in most people's minds, according to the Fed Fund Futures, is March. So that's when they're expecting to raise 25 basis points. But if this Core PCE Price Index number comes out much higher, let's say 0.6, 0.7, 0.8, all of a sudden it puts the Fed in a dangerous situation. And behind closed doors, those voting members of the FOMC are going to be going, uh-oh, Houston, we have a problem here. What do we do? They may be forced to actually raise rates even higher and faster at that March meeting. Now, that is all speculation, but the more pressure is put on the Fed due to inflation numbers, the more likely they'll be forced to raise rates even faster, which is something we need to pay attention to as traders and investors for the short term and for the long term. That, my friends, is your Monday Morning Must-Knows. We will see you next week.